Alphabet is due to report earnings after the bell today. Shares, well, they've gone nowhere really for months, trailing Mag 7 peers as investors struggle to price risks confronting the company. Today's numbers will offer the latest insight into the health of big tech. Joining us now for what this means for the broader market, we want to bring in Krishna. He is at Barclays head of U.S. equity strategy. Venu, it's great to have you here on set. So talk to us just about how much is riding on these results. Lots of questions about valuation and whether or not they are a bit too full at this point.
So I think the first part of your question, a lot rides on it. If you think about big tech, which is a collection of 6 stocks, that's been the fulcrum for this market and holding it not just from earnings, from returns perspective as well. And I think what's interesting is that their earnings as a group is moderating from extremely high levels. So their comps are getting difficult. So if you think what the comparisons are, they were growing earnings over 60% in Q3 and Q4 of last year. That's what you're comparing with. And I think the earnings are moderating, but still are expected to settle in the 20s, which is extremely healthy. But I think the biggest uncertainty, or at least caution I have, is what do you pay for those earnings when they're moderating? And when they've entered a phase in which there's a significant amount of uncertainty around the timing of monetization of AI spend, the sheer scale of AI spend, and the historical experience in the last 10 years when this big tech or group has had a situation of high capital intensity in terms of spending and moderating earnings growth. And multiples have corrected reasonably strongly in those periods. So that's the setup we have right now, right? So as we're entering, they are trading at around 30, 31 times. I think that's on the high end. Their peak this year was 34. During the summer correction, they went down to about, I think, around 27, which is 20% correction, and now we bounced back, right? Now that said, their earnings are still rock solid.
Yeah.
They're highly, highly profitable. So, and if you look at this third quarter, what's amazing is that earnings numbers have been revised down quite sharply. For big tech, it's held steady. But for the rest of S&P outside the 494, it's actually gone down, right? Meanwhile, subsequent quarters have been left unchanged.
Right.
So I think so we are quite optimistic, but I think a lot rides on big tech to at least create that base of stability, even as they are moderating.
So much of those profits that you're talking about, though, that's been built with search in mind, with digital advertising in mind over at Google or over at Alphabet for decades now. But we're seeing a rapid shift, and it's both in the spending that they're putting forward now towards AI, but also in how quickly search itself is changing, and the top results that you're seeing could be more AI generated than before. And so that takes out perhaps 33% of the above the fold advertising that they would have been able to run. How significant of an impact do you think that could be?
There are a lot of these moving parts, and to be honest, the subject matter experts in those areas will be able to opine more closely. But I would say that if you take the big picture right now, all these companies have tremendous horsepower in terms of their capability and ability to execute on AI. Don't forget, when you talk about Google, they were at the forefront of the whole AI phenomenon well over a decade ago, right? So I don't think, I would be that negative that they're going to lose their core business, because one is these businesses collectively, if you think of the big tech, is a very broadly diversified business. It ranges from consumer devices like Apple to cloud services to digital advertising to retail like Amazon. It's a very broad spectrum. And that's the reason why when you look at the correlations between these 6 stocks, it's only about 40 to 50%. It reflects the breadth and range of the businesses. So I would say it's a risk, but there's no way that you can count them on. At the same time, you recognize that down the line, and that's maybe 2 to 3 years from now, there will absolutely be new business models created. There'll be some who will be out of business. There will be some companies who adopt AI just to stay where they are. In other words, that will be margin negative for them, right? So I think there's a whole bunch of changes going to happen. And the biggest uncertainty, or the biggest thing we are looking for, is will AI plus the combination of cloud lead to a significant enhancement in productivity in America, right? If you look at the last 3 to 4 decades of tech cycle in the US, starting from the PC cycle to internet to mobile devices, and now you're in cloud and AI, productivity has increased meaningfully. But it's also important to note that with each subsequent tech cycle, productivity gains have declined. So the question is, does a combination of AI and cloud accelerate the productivity? Right? There's a reasonable chance it happens, but we don't know. I think it'll still take about a couple of years to see in the application stage what happens.
So then, Venu, I guess given all that, the hype then surrounding AI, it sounds like it might be a bit overdone at this point, just given the return on investment, the fact that that might not come for years to come. If we do see these big tech earnings over the next several days just meet expectations, not necessarily exceed them by a substantial amount, what does that mean then for the broader market? How big could we be seeing a correction as a result?
I would say that, so that's a very good question. And you know what, everybody keeps focusing nowadays is on broadening, right, of earnings, and how big tech moderating is not necessarily bad. So that's the half glass full kind of situation. The reason I say that is historically, when big tech multiples have corrected, correlations have increased with the rest of the market. So in other words, you're not immune outside. And don't forget that, just like I told you in 3Q, it's the numbers for the rest of S&P which have been cut. And for big tech, it has been left relatively unchanged. So to your question of if they just meet expectations, that's not good. So if you look at last quarter, collectively as a group, they beat earnings by about 5.5%, 6%. But for the 4 quarters before that, the range was anywhere from 8.5% to 14%. So I think the scale of surprises in the 5 to 6% is reasonable. Anything less than that, I'll be disappointed. Anything above that is phenomenal. They will be back in complete control compared to especially the rest of the market. So I think that's where the rubber meets the road in terms of their mature businesses, which you were pointing to, Brad. How well they're holding up. And that's been a mixed bag, right? For Amazon, for example, the retail has been really reasonably strong. For Google, the YouTube, I think, was weak, but search was relatively strong. For Meta, digital ads were great. So it's been a mixed bag where some parts have done well, some parts not that well, right? So, but all these companies are telling you that this AI phenomenon is so huge that none of them is going to back away from the spending they're undertaking right now, because they do not want to be left out of the race.
Where do you believe the deepest value opportunity is within tech, especially considering the Mag 7 and the thesis that has really been lighter fluid for them, which has been AI, which is what we've been discussing here this morning?
Yeah. So biggest opportunity, you mean broadly within the tech space? I would say that for big tech, this group of 6, my best approach to them is to have a market weight in it, because the fact that the correlation between them are 40 to 50% means at any point in time, if you're bold enough to be a stock picker and you get it right, it can work very well. But I can tell you that a lot of people have got it wrong. There are people who are short Apple because of declining fundamentals, but then Apple's prospect changed dramatically once the market woke up to the fact that they probably are in a good position to implement AI through their apps because they control the mobile device market, right? So I would say that group is something which I am hesitant to try to take individual bets, but as a group, it's a great place to be in. I'm worried about the multiple you pay, right? 31 times, I think is above my comfort level, right? Not dramatically so, but what I would argue is that if you look at outside of big tech, if you look at the S&P 494, so there are different ways or themes in which you can take to take advantage of the fact that you don't want to be so concentrated in 6 stocks which are controlling 30% share of the S&P, for example. And I think one way to think about it is we undertook an interesting exercise, I think roughly 6 months ago, where we said, let's look at why big tech is doing so well. And we looked at 5 or 6 parameters in which they were hitting it out of the park. And we said, let's try and replicate these sort of metrics outside with the eye on diversification, knowing fully well that you can approximate it but not replicate it, right? And so that basket of stocks of roughly 50-odd stocks actually has been doing very well. It continues to close the gap with big tech. It's up around 23, 24%. And big tech is up 40%, right? But it's doing much better than the rest of other names in S&P. So I think you have to be creative in this market and look at themes in specific stock-specific areas to sort of get a exposure above and beyond the big tech.
Venu, we got to go. You were talking about S&P 494 versus the 493 that we're talking about, and Magnificent 7 that we were talking about versus 6.
Yeah.
Which one have you already booted out?
Well, we've never considered Tesla as part of our.
All right.
When we say big tech, that is clearly in a different domain of auto, sort of with the tech leaning and other stuff. But Tesla was never a part of our big tech definition.
Venu, great to have you here in studio with us today. Venu Krishna of Barclays, thanks so much for taking the time ahead of the opening bell.